kind of spend the day around here, maybe some bounce along the day. Let's see. It'll depend on headlines. Nifty Bank, 54,580, and it's been a bad week. We've been, of course, flagging this from Monday morning that it started cracking late, but as it started cracking, it's quickly lost a fair bit from the highs. The Sensex down about 0.75%, the small cap index down 0.5%, the mid cap index will come up as well, and there is some amount of pressure. 2:1 in terms of declines to advances. 480 stocks are higher and about 800 stocks are lower. Prima.
Well, third day of losses for the markets now, and this week's loss tally stands at 4% for the Nifty and the Sensex. Autos once again under pressure. The Nifty Auto Index is down 1%, with M&M lower by 2%. Eicher Motors weak in trade, that's seeing a cut of 1%. The street fears the geopolitical conflict, rising commodity prices will create cost inflation for the Indian auto industry, and plus the weakening consumer sentiment could also derail the recovery that we're seeing. L&T under pressure. L&T is lower by nearly 2%, sliding 7.5% this week. It's in the midst of the Middle East conflict. Banks are weak in trade. The Nifty Banking Index is down 500 points, with HDFC Bank, ICICI Bank lower by 1.5%. The overall macro stress in the Indian economy will hurt private sector banks. Adani Ports, Tata Steel weak. Ultratech Cement is lower by 1 1/3. Shriram Finance under pressure. That's also down about 1.25%. IT on the back foot today, so 1% gone for Infosys and HCL Tech. On the way up, once again, it's many of your PSUs, power names. Power was the big theme yesterday. Power Grid on top of the charts, 1% up. On Coal India, the expectation is that e-auction prices will be higher. So that's lifting Coal India's stock price today. NTPC also up in the green, and Eternal was flat today. No recovery after the recent selling, but no selling at least. All in all, it's down about 3/4 of a percentage point on the Nifty and the Sensex, but it's broken yesterday's intraday low of 23,550. Today, it's 23,450 on the Nifty.
Yep, that's where we are right now. But, the broader markets are a lot better at the opening today than it was yesterday. Yesterday, we had about 400 stocks which were in the green, and this morning itself, we have over 550 stocks which are in the green. So the market breadth actually is a lot better at the open. Let's see how it progresses from here on. Power has definitely been the theme of yesterday and continues today. The important part, however, the stock of today and this week has been Adani Total Gas. Something is definitely underway out there with a 5% up move yet again today. The weekly gains on that stock are at 32%. So that's a big move that we're seeing. NHPC is up around 2% in the broader markets. ABB India, Nimesh highlighted that stock in his standout brokerage note. That one's higher too. And we are seeing a big move on NTPC Green Energy as well, which is up 5.5% straight off the bat. This week's gains on that stock are up around 17%. Continued buying for some of these induction cooktop makers like TTK, Prestige, etc. We've seen that stock too put on about 25-26% this week, and we've seen Eureka, Forbes, and the others also come into the picture today. Among the stocks which are selling off, some of these tire makers are lower. So CEAT is at the low point of trade. Devyani International. Yesterday there was news that came in from Pizza Hut. Their social media account said that due to LPG crisis, their deliveries would be very limited. So Devyani and Sapphire obviously are Yum brands. Franchisees and franchisors in India obviously announced the merger. So both those stocks move in tandem. Devyani and Sapphire are lower amidst some sort of relief coming in for names like Jubilant Foodworks. And you spoke about Eternal. Swiggy also is about 1% higher. So that's pretty much about it, the way the market is. We have 558 stocks which are on the NSE in the green, 1,800 stocks which are in the red. A bunch of them from yesterday continuing their up moves, and a lot of these oil-related plays which are moving in the direction, whether they're, it's upstream or downstream. The ones which are upstream moving higher. HOEC stands out in that, and the downstream ones, they are under pressure today.
Absolutely. 190 points gone, 0.8% lower is what you have, 23,450 at this stage. Nilesh Shah is with us, founder of Envision Capital. Nilesh, welcome to the program. Thanks very much. You're a micro guy, and that's helpful at times like this, right? Because, macros, as someone posted, human beings were not built to track this amount of headline and news flow, right? Makes the head spin. And what do you do with all of it at the end of the day is the question. So I guess at some level, better to focus on what is understandable and maybe knowable in some sense, and that is companies and businesses. So across your portfolio, Nilesh, just give us a sense of what you're seeing. I mean, have you run a broader market analysis of the drawdowns we've seen? Are broader markets now at attractive levels? Just start there.
Surely, Prashant. Thanks for having me here. And I think from a valuation point of view and from a multiples point of view, I think we're down to historical averages. So that I think is honestly a great situation to be at. This is really where over a period of time we see the markets, which do tend to kind of find great support and do tend to kind of come back from there. Notwithstanding the fact that clearly the macros and the global news flow is extremely negative, and it's hard to essentially have a positive stance. But the bottom line is that valuations have come off. We've gone through time-wise corrections, and we're now down to those historical averages. Clearly, amongst the mid and the small cap space, we're seeing now a bunch of stocks, sectors where valuations probably are even as down to 12, 13, 14p multiples. And these are businesses still growing at about 20 odd percent. So clearly, on the whole, this requires basically a way more constructive stance. We've seen in the past geopolitical conflicts impacting sentiment, impacting valuations, impacting prices, but they end up being great opportunities to essentially kind of add to positions or even continuing to build the portfolio.
Right. What's perplexing, Nilesh, this time around is the underperformance of the Nifty Bank. One would have thought that maybe because of its domestic facing nature, relatively better asset quality in the banking system right now, across all these things with not a big jump in valuations either, it was a place to hide. But that's the one, after its outperformance, has actually underperformed. And in a way, it's dragging the market lower. Even now, as we speak, the Nifty is down 200 points, and it's the biggest culprit is the Nifty Bank, which is below that 54,500 mark as well as we speak. 600 points gone in the Nifty Bank. What's perplexing, or what according to you is hurting the banking index right now? Are you part of the PSU versus private banks sort of debate as well?
So Mangalam, it's banking as a space has done relatively well, especially at the index level, maybe over the last year or so. And many of these leading PSU banks, private banks, all had delivered a very strong stock price performance. So that's essentially, I think there's some basically money being taken off the table. It's also probably players who are looking to basically hedge their bets, and they think probably that having a more nuanced stance on banking might just be helpful in the current environment. So I think that's what is playing out. Third, inevitably, I think banking becomes a proxy to basically where interest rates are moving, yields are moving. Maybe the whole story of rate cut cycle is now behind us. We probably get into a pause mode, or maybe if oil remains at elevated levels, we could see the pressure exerting on inflation, which could lead to basically maybe interest rates moving up. That probably is something what the markets are currently trying to factor in. And lastly, global investors still continue to own a lot of banks. And I think it's just basically them trying to adjust their positions, maybe pruning some of their positions, given that they still own a fair bit of banking stocks. So I think it's a combination of all of these phenomena. But basically, I think the fundamentals still remain solid for the banking system in India.
Is this a time to aggressively buy right now, Nilesh? Or because we still don't know how long this conflict will go on, the fog of war continues to question mark the duration of the war, it's still better to avoid before deploying?
I'd probably say just have it on the watch list. I honestly don't see a significant or a material downside to it. Maybe, yes, on an individual basis, stocks can possibly correct by another 5 to 10%. But that again just creates an additionally attractive buying opportunity. So I'd continue to be positive on banks. Maybe there's, yes, a 5 to 10% decline in individual stocks, but I think that's really how the overall market currently is positioned at.
So positive on banks, maybe another 5-7% downside. And this is large cap private banks, Nilesh, we're talking about?
That's right, Prashant. I think look at just the valuations. I think all the leading private banks are now hovering down to significantly lower price to book value. They're probably a lot lower than the historical averages as well. And I don't think the earnings profile or the earnings trajectory of large private banks is materially impacted even by this event.
Nilesh, with full disclosure, uh, you said, right? I mean, lots of mid and small caps have come to now trading at 12, 13 P ratios. Growth offered is still 20%. Just, I mean, give us a few examples just to think about, chew on. As I said, with full disclosure, not not as investment advice. I mean, I think everyone should be careful and check their own, trust their research or trust their advisors. But just your thought process, Nilesh.
Yes, so I think clearly, I think from in the mid and the small cap segment, it's across a variety of sectors that basically value is emerging. Many of these stocks have already corrected about 50% from their 52-week highs or historical highs, and that's what has basically led to a trading down of their valuation multiple. So I think I see that across the board, but just kind of getting beyond individual stocks. But I think three pockets which essentially look extremely good overall in the current environment, or even from a medium to long term perspective. Firstly is the overall the digital platforms and businesses which are proxies to the whole digitization that is currently underway in India. I think that's a very attractive pocket. Second is defense. Clearly, I believe that the earnings expectations or the possibility of a significantly higher earnings in the entire defense pact has improved quite significantly with whatever is going on geopolitically. Third is pharma. I clearly believe that the pharma is clearly the seems to be a very standout space. Several things going for it. One is, of course, the strengthening of the dollar, depreciation of the rupee is, I think, augurs well, given that pharma companies are net exporters. Two is pricing power that they have. Even though API prices might go up due to higher raw material prices or there might be higher freight costs, but I think they have the ability to have a pricing power. And third is this whole GLP-led opportunity, which is there. And clearly that's going to be a very big opportunity starting April this year. So clearly they have an added layer of growth. So I clearly believe these are the three sectors which I think investors from a medium to long-term perspective need to kind of watch out for. And this is really where portfolios will need to be positioned.
Right, that's an interesting one because we had done an entire town hall on the GLP-1 opportunity, the impact that it could have on your portfolios. The positive impact obviously coming in for the pharmaceutical space, the adverse impact, the second or third order impact could perhaps be on the way consumption is, changed fundamentally. But, you did speak about the digital platform theme. Nilesh, a couple of these stocks in that theme itself have seen sharp corrections from the top, be it Eternal, which has been among the biggest losers, down 40% from its highs. We've had a decline in Swiggy as well. Even Urban Company, while this week it's found some buyers, it's again down about 45% from its post-listing high. In fact, at some point went below the IPO price as well before it saw some buying resume. What are your thoughts on the digital space? In particular, what parts of that space look a lot more attractive than the others? Because the theory is that maybe consumer-facing digital plays have a lot of moat around them, but some of these financial players are all fungible because it's very difficult for them to get to cross-sell, etc.
That's a fair point, Banglam. And clearly, I think the quick commerce pack is witnessing heightened competitive intensity. Honestly, one doesn't know for how long this will persist, but I don't think it is going to basically last for a very long period of time. Yes, it could be there for another maybe a quarter or two. But I think beyond that, I believe the competitive intensity should pretty much normalize. It's not that there hasn't been competitive intensity, but I expect it to basically normalize. And clearly, I think with the kind of price shave off that we have seen in the couple of listed plays on the quick commerce side, I clearly see now the risk reward getting hugely favorable from a most likely medium to long term perspective. Coming over to basically the fintechs, clearly on the equity broking side, the digital platforms which are there. Yes, I think for them there still are likely to be headwinds given essentially a slightly lower and a subdued market activity. But currently, I think the places in digital platforms, which is looking, I think, rock solid for now. Right now is, I think, the payments space. There, I think, while there has been competition, but there is a lot of cross selling happening, especially in terms of credit. The other is clearly the beauty and the personal care digital platform. Their businesses still continue to grow at about 25% odd. And I believe that the consumer spending there is not going to be impacted with whatever we are seeing on the macro environment. So I clearly believe that there are still pockets which are continuing to have solid performance in the short term, but they look extremely attractive even from a medium to long term perspective.
Thank you, Nilesh. Great conversation. Thank you for joining in. The Nifty is now at 23,465. We had dropped to levels of 23,415. So from that level, there has been a recovery of about 50 points. And consumer names are seeing buying. HUL, Nestle, ITC up in the green now after opening lower, 0.5 to 1% higher. But let's talk to the management of PG Electroplast. Vikas Gupta, Managing Director of the company, is now joining in. And with him, we'll discuss the relaxation in Press Note 3 guidelines, the impact of lower gas supply allocation, and the update on the compressor JV. Thank you very much for joining in. On the 9th of this month, you intimated to the exchanges about how the availability of gas has become severely constrained to your company. And you went on to say that you're assessing the situation, and as of now, the potential impact of the ongoing shortage situation cannot be quantified. You would have had a better sense now. It's 4 days past. What's been the extent of production or volume loss that you've seen? And to what extent has gas been curtailed as a percentage of your overall production?
Good morning, Rima, and thanks for having me on your show. So please understand that right now the situation is quite volatile, and we are still not being able to, make a sense of how the things will work out. And definitely there has been a disruption in the production schedules for us on a daily basis. And we are seeing a shortage of LPG availability for our various plants where we manufacture our air conditioners right now. So that is quite a challenge. We are working on with the gas vendors. We are working with our supply partners to see how we can mitigate and try to minimize that disruption.
Yes. What is the quantum of cut? Good morning.
Good morning, Prashant. So the quantum of the cut is like this. Prashant, please understand, we are working on a daily basis right now. Like today, we are covered for maybe today and tomorrow we are covered, but we don't know how it will happen for day after tomorrow or something like that. So it is quite volatile. It is very difficult to say that. But definitely any loss of production or any loss of production in this peak month actually has an impact on the overall numbers that we can achieve, because March usually happens to be a peak month for the production and sale as well.
Yeah,
that exactly is the question.
On the average, Vikas, on average, if you can just last few days since this started, what is the cut? If you can, is it 5%, 10%, 15%, or is it much more?
So Prashant, like out of 4 manufacturing plants for AC, like 2 manufacturing plants were not able to operate for 3 days in last 1 week.
So that's a 50% cut for 1 week.
Out of 1 week, last 4 days, there has been no production in 3 plants out of 4 plants.
So what does this do to your guidance? 5,800 crore with the top line guidance for FY26. You said March is an important month for you. How much of your guidance will be missed because of this unforeseen circumstance?
So Mangalam, it is difficult to quantify, but definitely there will be an impact on the achievement of the revenue guidance. I cannot give you the exact number, what will be the impact in the percentage terms or in the absolute terms. But what I can tell you, there will be an impact on achievement of that revenue guidance.
Okay, if you could give me a sense, we'll back calculate that. March as a proportion of sales, how much does that account for in your annual sales?
So it can be like, it can be almost as high as around 12 to 15%.
Okay, 12 to 15% of your annual sales may come from March,
yes.
And a week of that has been impacted. 50% of that has been impacted. So back of the envelope calculation suggests that maybe a percent or 2% sort of impact, at least that has happened already. And if this continues, maybe 0.5% or maybe 1%, 2% more. Would that be a fair estimate? Between 2 to 3%? Just mathematically speaking.
So I would not be able to give you the number on that. What I can tell you that we are trying to work on how we can salvage the situation. We are working more on that instead of calculating how we are able to achieve that revenue guidance or not. That our teams are more focused on how we can mitigate this. We are working on some alternative technologies, alternative gases.
That is
Our
absolutely
technical
fair.
teams are
That is
working on
absolutely
that.
fair, and that's
Yeah.
what your team. That's exactly what your team should be doing. But the analysts will have to look at the impact of that in this financial year. And
if I can just confirm, Vikas, just to confirm, right? You said in last week, this is not this week, but last week, 2 out of your 4 plants did not work, right? That's what you said. And this
For 3 days, 3 to 4 days out of the complete week.
I see. Okay, we'll just, okay, it's not, because what I heard first is 2 out of your 4 plants did not work last week, and in the last 4 days, 3 out of your 4 plants did not work. Is that not what you said?
So I'll tell you. So Prashant, out of 4 plants for manufacturing of vehicles, last week there was a disruption of 3 to 4 days. This week there has been already a disruption of 2 to 3 days. So if you look at, we have almost lost 1 week of production.
And that 1 week of production, I'm just mathematically calculating, 15% of your annual revenue is coming in from March, 7 days loss. That comes to about 1.75% specifically. But we'll let that, we won't allow, ask you whether that is true or not. The analysts will make those assumptions. Now, the second part is that the government had come up with easing of the FDI norms with PN3 approval. What's the latest on the company's compressor JV with Highly? Do you stand to get affected by this norm that has come in? And as a result of which, does this JV with Highly go through?
So Mangalam, let me correct here, because I've said this thing earlier also.
Yes.
It's not a joint venture that we are getting into with the compressor company in China. We are getting into a contract manufacturing agreement where we will be putting up all the investments, and there is no investment coming in from a Chinese technology partner.
Okay.
So the question of getting a Press Note 3 approval is not there in our case right now. So we are already working on that. And we have already started placing the orders for the equipment, and we are hopeful that we should be able to start the production of compressors before the end of this calendar year.
You know that because that Press Note 3, right? This is the approval, you're awaiting approval from the Chinese side, right?
Yes. So basically, Prashant, so there was a issue related to the approval from the local Chinese government.
Correct.
So there was no angle of a Press Note 3 approval in that.
Exactly, because Press Note 3 is for investments into India,
Yes.
And if there is approval which is stuck, then that perhaps gets faster. But this is from a local Chinese side, in that sense. Yeah. Now, just give us a sense, Vikas, if you will, on, there were some reports that maybe, and now suddenly the weather has turned and it's become quite hot, etc. But there were some, 10, 15, 20 days back, some reports that it's a little cooler for longer, AC sales perhaps not moving as fast and those kind of things. So is there already enough inventory in the system, Vikas, in that sense? And that is now perhaps getting used even as your production is disrupted, just trying to get overall sense.
So Prashant, what I feel now, there's the tertiary movement or the secondary movement has improved quite remarkably in last 2 weeks, 3 weeks. And there is a kind of a sentiment which is quite positive in the channel partners right now. And we are all hoping that there will be an extended summer. And our teams currently, what we are looking at, if we are able to resolve this LPG situation and work on some alternate technologies, we should be able to cater to the demand for our customers' plans in the coming months of April and May. So that is what we are looking at.
So in the last 2 weeks since the start of the conflict, have you managed any alternate sources? How difficult is that? At what point do you think you will be able to mitigate the situation with another source?
So I think we are working on some alternate technologies, and our technical team is working on some particular process where it is very critical during the manufacturing process for air conditioners. So we should be able to find some solution to that in 7 to 10 days' time. And maybe the April month will be better because once we have this process in place, a new process in place, the April month will be better.
Can you tell us a little bit more about this alternate technology? Is it an alternative fuel source or another way of, building by? Tell us a little bit more about this.
So it's an alternative gas. There is an alternative to the LPG that we are trying to work on.
Okay.
And I do not have the technical details right now, but we are trying to repurpose our existing equipment also, which is used in the bracing and the welding of those copper tubes. And we should be able to come out like this is what my technical team has gave me that download yesterday night.
Okay. April should be better. What's the cost associated with repurposing your machinery? Is it significant?
It's not. No. So the cost associated is very, very minimal.
Okay,
the main issue is finding the source of that alternate gas.
Okay, got one more question. One casualty of the conflict has been on LPG and the shortage, etc. Anything else? Any other collateral damage? For instance, helium prices have doubled. And that also, is an important critical part of your production.
Yeah, so I don't consider that as a main issue. Other than that, there is a availability issue related to the polymers, petrochemicals. And we are seeing a surge in the prices of the polymers. In last 10 days, the prices of polypropylene and the plastic raw materials like ABS and HAPs have gone up by 40 to 50%. So that is also an area of concern. The availability of those polymers is also becoming a concern right now.
Right. So does that do anything to your margins, or do you pass this on to your customers? And since we're talking about that, just a final question on the outlook for room AC demands, because day in day out we're getting updates from the weather department saying that this could be a hotter summer. Last year was obviously a washout for cooling products. So are some of your clients asking for more this year, and how are you supplying them because production is lost?
So Magnum, what I've said earlier also, like what we hope that once we are able to find a solution to this LPG scenario right now, and as our teams are working on some alternate technologies, we should be able to come out of this in next week to 10 days time. And as we are hoping for an extended summer, we feel that the months of April and May will be better in terms of sales for us.
All right. We certainly hope so too. It's going to be a hot one, and we certainly need air conditioning. Thank you. And generally, I think we can do with less heat, right? Not just from the weather, but otherwise also. Thank you very much. It's a tough one, but I think perhaps better in the coming days and weeks. Thank you. 500 on PG Electro Plus. Stocks down about 5-6%. We'll take a break. Dilip Bilkon is going to be joining us. The government's extended the Jal Jeevan mission to 2028. We discussed the outlook going forward. Stay with us.
Welcome back. The Nifty is still around 23,424. It's a big cut that we're seeing at the low point of trade, actually, and led lower by the Nifty Bank, which is holding below that 54,400 mark. But a bunch of stocks which were on our radar a couple of days ago were the pump, pipe, and EPC stocks. And that's because the Union Cabinet recently approved the extension of the Jal Jeevan Mission till 2028. They've also upped the allocation by about 1.5 crore rupees. The total program outlay now pegged a little under 9 lakh crores at 8.7 lakh crores as well. Rohan Suryavanshi, who's the head of strategy planning at Dilip Buildcon, joins in to discuss the opportunity from the Jal Jeevan Mission, FY27 outlook, and the group plans going forward. Thanks a lot, Rohan, for joining in. It's been a while since you joined us on the channel, so welcome back. The question, obviously, is of your current work, of the current work that you do, what proportion comes in from Jal Jeevan Mission? With this extension, what's the increase in the scope of the work that you would do? And one of the problems with the Jal Jeevan Mission, at least over the last year and a half, were the delayed payments. Did you face the same as well? What's the kind of receivable that you have from that?
So hi, thanks a lot for having me on your show. Such a pleasure to be back. It's been a while. Of course, a lot has changed in our business as well. From when we used to earlier speak, we used to be primarily focused on road EPC, but now we've really diversified ourselves, and we're doing, roads, bridges, dams, canals, water supply projects, mining, airports, everything. But to answer your question, the Jal Jeevan Mission is a very small portion of our order book currently. So our order book stands at about 29,500 crores, or in that range. And I would say the Jal Jeevan Mission projects is roughly, the remaining amount is about 467 or something odd crores. So it's a 1.5% of our order book. While we welcome the government's sort of step in terms of increasing the allocation and increasing the timeline, and we remain optimistic about more projects to come in that space.
Do you have stuck receivables from Jal Jeevan Mission?
We don't have stuck receivables. I think that's a more localized problem to certain states. We have about a month receivable from Jal Jeevan projects. It's about, I think, 90 odd crores and all, which is sort of typical in our sector and our industry.
Right. No, absolutely. That's interesting. Rohan, hi, good morning. I must say it's been a while. So what, a few years, maybe more.
It has been.
You're looking older, wiser. Not that you were not those two things earlier.
Just older, not wiser at all, definitely. You still look very young and the same, man. So I need to know what your skincare tip, routine is.
No, there's nothing. Absolutely
Diet
nothing.
and the exercise that you're kind of following.
Nothing. Rohan, so it's good to see you and speak to you again. So what's the opportunity here? You said there's 90 crores in receivables. So that perhaps, also gets expedited with this now coming through. But what's the opportunity size, as you see, from this program now?
I think the earlier allocation was about 4.5 lakh crores, and I may be a little off on the numbers, but now it's been increased to almost about 9 lakh crores. A lot of it is also because there is cost escalation, so the opportunity size may not be as much. But we take whatever opportunity size the government gives out a bit cautiously, because I think those numbers may not necessarily materialize. But I think still there will be a few lakh crores of orders across the country that will come. For us, Jal Jeevan Mission is only like a very, one part of what we do. Like I mentioned, we're now doing work across 10 different sectors. So for us, each sector would be roughly 10-15% of our order book. So, and given that our capabilities lied in our EPC strengths, the way that we used to execute with our own equipment and people, we are very much agnostic about where the opportunity comes, as long as it comes at a rate that we are comfortable with.
Dilip, I have to ask you this, because I remember we had 2 days back, we had another company with us on the Jal Jeevan issue, and they said that there were some companies which were flagged off because of some malpractices, etc., and they were kind of sort of any projects that you've undertaken over the last couple of years which kind of sort of fell under that ambit over the last few years?
Fortunately, we've been fairly well received by the department, and we've actually done some really cutting edge work. Even for our projects where we were building water tanks and all, we wanted to ensure quality, so we went for prefabricated tanks, and so it was really high quality rather than constructing on site. So ensuring that a really high quality product came out. So that was very, very well received by the government, and they were obviously are sending other players as well to kind of look at the kind of work we were doing. So we're very lucky that because we controlled every aspect of our construction sites, and because of the pride that we take in each of our sites where only our people are working and our equipment is being used, we've not faced any such issue. And in fact, we've been applauded by the government on multiple occasions.
Rohan, you all divested about 25-26% stake in 7 out of the 11 HAM projects. This happened recently to Alpha Alternates. What is the debt currently on the company's books? What more by way of divestment and plans to bring down your debt?
Absolutely. Hi, Rima. So first of all, we divested 7 projects to Alpha. The idea there was that we wanted to partner with them, and we gave them 26%, and we wanted to set up our own InvIT, which has also been set up. Last October, we just had a listing of Anantam Highways. Now, the idea was we wanted to get a partner as a part equity contributor to our PPP projects, and where both of us go and jointly tap the capital market, set up this listed platform where even in the future, we can keep putting in assets, because earlier DBL used to sell those assets to the different funds. We wanted to get out of that race. We wanted to hold these InvIT units. Going forward, we wanted to have predictable, consistent cash flows coming for us, and that's basically what we did. So 11 assets are still remaining. Against the 7 assets that we already put in the InvIT, we have received about 1,400 crores of units of the InvIT. Against these 11, which will go into the InvIT in FY27, all of them will conclude in FY27, we will receive another 2,100 crores of units. So total units that DBL as a company will hold will be about 3,500 crores. Now, that's the asset and the investment portfolio that DBL will have, and this will roughly give you about 400 crores of dividend income every year. So at the InvIT level, profit after tax paid, DBL will receive almost 400 crores every year for the next 14, 15 years. So that's the kind of idea that we had as a company. Now, talking about the debt, obviously there are 2 kinds of debt on the company. There is the standalone debt, and then there is the consolidated debt, which we take for the projects such as these. So the consolidated debt will keep on going away as we complete these projects and keep on moving them into the InvIT platform or sell them to any other player, like some of the other assets that we are taking for the future. On the standalone debt, I'm very happy to report that, when we used to earlier interact, our debt at its peak was almost about 3,500 crores, which was about the breakup of that was about 2,000 crores of working capital and about 1,500 crores of equipment debt. That 1,500 crores of equipment debt has completely gone. So we have about a 4,000 crore gross block of equipment, which is about 1,000 crores of completely net block. And we have about 2,100 crores of working capital debt. But against that, like I was mentioning, we have 1,400 crores of units of the Anantam InvIT. Plus, we also have 200 crores of units of the Shrem InvIT that we had earlier divested into. So 1,600 crores of units. Unlike other players who sell all their assets and take all the money, we decided to hold these. Had we also sold these assets, we would have had this 1,600 crores or more of money in the company. So our net debt would have remained only 500 crores. But because we did that, that's where it is. But in the next 2 years, we will be nearly net debt free because of the cash flows that the company will kind of generate. And that's the idea and goal. On the standalone level, we will remove our debt. We will improve our ROE, our ROC. And on the consolidated basis, we are looking at building long-term consistent cash flows with platforms such as the road InvIT. There is a renewable platform in the works that we're kind of thinking about. There is the mining business that is also going to be throwing out.
And sorry, Rohan, sorry. We will.
I'm so sorry.
No. There's a lot happening, and I understand you want to share. What we'll do is we'll invite you back, and we can maybe do a bit of a deep dive on the business itself, right? And all these different segments you're talking about. But for now, I'll thank you, and I hope this is the start of many interactions. Appreciate it. So that is Dilip Bilkon with what's happening in the business, and of course implications of the Jal Jeevan Mission, new allocations from the government. Well, as the war in Iran intensifies, global sugar prices have gone up. There is, of course, also the ethanol angle. Vivek Sarogi is Managing Director at Balrampur Chini Mills. He's been waiting by. Mr. Sarogi, good morning. Good to have you with us here. You know, before I come to you, I just want to highlight what Prime Minister Modi said yesterday. And I want to just put this up for our viewers because I think it'll establish the context. So this is what he said. I'm reading verbatim his comments. He said, this global crisis has once again demonstrated why it is so important for any country to be self-reliant. To reduce dependence on petroleum, we emphasized on ethanol, biofuel. Before 2014, the country had only 1 to 1.5% ethanol blending capacity. Today, we are nearing 20% blending in petrol. If this had not been done, we would have had to purchase approximately 18 crore barrels of additional oil from abroad in the last 11 years. Looking at the current situation, due to ethanol, we have to import approximately 4.5 crore barrels less oil per year. That is, of course, Prime Minister Modi himself on ethanol. Now, I thought I must sort of put this up before I come to you, Mrs. Sarogi, because I think you kind of sort of echo that voice, and you're a prominent player in both sugar and, of course, ethanol as well. But there has been, over the last few years, a little bit of policy inconsistency with regards to ethanol from sugar, from maize. So just lay the context out, and then we'll go back and forth. Go on.
Thank you. Good morning, everybody. The issue is the ethanol supply is intact, but that is being not looked at ethanol properly. So last 3 years, government has not raised the ethanol price. Earlier, it was being raised as a percentage to the rise in FRP. So currently, last 3 years, ethanol has been stagnant. If the supply is to continue unabated, and I'll come to the point where we need to increase the supply, the prices need to be looked at. So that is a big grouse. And for what? For peanuts. Maybe 25, 30 paisa is the maximum increase you need to do on the petrol price.
Yeah. So,
sorry.
So you're saying supply is intact, right? All that investment has gone in and supply is intact.
But if the price is not raised and sugar price goes up, one can easily shift back to sugar and leave ethanol.
Yeah. Are we at that stage? Right now, Mr. Sarogi?
Yeah, but it may come, Prashant. And government is not a trader. Government should not see, I buy this, I sell this. Government has put in a policy where they committed to you in no uncertain terms, and gave interest subvention to set up capacity and said, please produce ethanol because we need it. The premise was blending will go up 20%. And there is another, BI standard being developed for 22 and 25. Ethanol can be used in so many other things. It can be used in homes.
Yeah.
So being done in Kenya. Yeah. So in a plethora of uses, the idea is to first see how and at what price you need to buy it.
Yeah.
And today, if you were buying ethanol, it'd be way cheaper than importing crude. At 90 rupees to the dollar and $100 to the barrel.
Yeah. So that's the. So you're making a case that prices should be. I mean, they've not gone up for the last 3 years, and it should go up as it used to as a percentage of FRP, and this will ensure that investment which has gone in and the supply, etc., remains firm. Because as I just read out, I mean, of course, during times like this, you realize why you need to be self-sufficient as much as you can. The other point you made is households, right? And just talk to us about that point as well.
So I'm just taking quickly a very larger point. There's a bio-E3 policy announced by Government of India. What does it say? It says reduce dependence on fossil fuel, and in brackets, fossil fuel is imported. 60% of your LPG, everything. So 60%, I believe, of your fossil fuel is imported. You import that basic raw material and then you refine it here. Okay, you could be making chemicals out of that, you could be making petrol out of that, diesel, anything. I'm saying India is sufficient in biomass. And this is what the bio-E3 policy says. So biomass, if let's say sugarcane is biomass, maize is biomass, there's enough biomass and starch available in the country to be able to give you a plethora of chemicals. As you're aware, we're going to bioplastic, give you ethanol. Ethanol can be used in Kenya. People are using it in cooking gas in stoves at home. So it is a policy which needs to be understood on the overall context. Atmanirbhar Bharat should be genuine Atmanirbhar Bharat, not processing in Atma and calling it Atmanirbhar. If you don't play with this biomass and if you do policy which is not stingy, which encourages the environment for investment and continuity of that investment. So we were one of the first people, a very quick example, Modi ji was the CM in Gujarat. They bought, and solar was just, about to begin. The then capital cost was 12 crores a megawatt. PLF was 18%. We would given a PP of 15 rupees per unit. With that initial support, technology developed, PPAs, prices came down, capital costs reduced, PLF went up. So any kind of thing which is supported for a bit and then said that this is the direction can move up. So ethanol has a lot of uses, is what I'm saying. Other bioproducts have a lot of uses. So Atmanirbhar Bharat should be moving towards biomass, bio-ethanol.
So have you brought down your ethanol sales target or volume production target for FY26? And what do you expect for FY27 if there is no increase in prices?
We, in this year also, we did curtail our bidding by 5% odd. In the next year, if this is to continue, God knows what can happen. And if the sugar prices remain firm, as a businessman, you might bid 50%. I'm saying we, government and industry should not be at loggerheads that, I'm not bidding, you're calling for the bid, therefore raise the price. It's not an attritional relationship. It's not a trader relationship. It's an industry-government relationship with a long-term mandate in place. It is at these points that you realize how important this is. And I brought up a larger context where these things can be used ad infinitum for a lot of things.
Yeah. And I have to say this, and I want you to respond on air. That's why I'm bringing this up. There's been a fair bit of, with regards to this fuel blending, etc. The government has already clarified it. But all this talk of that that it damages vehicles and engine, etc., etc., etc. That kind of, it was all over social media. I wanted to respond to that.
There's a PIB clarification by the government of India. How this actually improves the knocking of the engine. It's RON 95, which means there's more oxygen. And this improves the acceleration and the engine efficiency. Yes, on a very minuscule level, it does reduce the mileage. But that's like 2 to 3, I think 2% at best. So overall, it is much better. In the larger context of things, in this overall, if you see the maintenance, engine efficiency, etc., it might not be, if I cannot go and stick my neck out, say it's cheaper, but it will not be more expensive.
Okay. And of course, if at a net level it is neutral to maybe slightly positive, and add to the fact that we have it here, that I think
environment friendly, hugely environment friendly. So you go out and say, I'm spending trillions on climate funds. This is climate. This is rural growth. This is biomass usage.
What about water intensity, Mr. Sarogi? That's the other criticism which we hear often.
Thank you. Good question. So there was a sort of charade going on, and which said that sugarcane is a water guzzler and maize is water friendly. Studies have been given, and government in itself in the parliament, they have acknowledged and clearly said now that for each liter of ethanol produced, sugarcane uses the minimum groundwater, minimum. Rice and maize are used much more. So that also controversy has been laid to rest.
Okay.
There are controversies created, if I may say.
Okay. Just last quickly, Mr. Sarogi, when is the cycle, if there were to be a hike, right? Typically, when does this happen, ethanol prices?
So, legally, the contract says government may raise the price or reduce the price as in, if the situation demands. So there is an opening left for raising the price for this year, and it can be done retrospectively. But I've not seen that happen much. So I hope they give some incentive for the balance period. However, the next cycle will begin from 1st November.
Okay, 1st November. Good conversation, Mr. Sarogi, and we covered a fair bit of ground. I'm sure officials, government, etc., are also listening to you and the arguments that you made so forcefully.
And it's not an argument.
Yeah,
I am laying the facts in order.
Absolutely.
It should be seen.
Yeah, absolutely. Thank you very much for joining us here on CNBC-TV18. It's always a pleasure. Thank you. So that is Balrampur Chini, and essentially, the importance of ethanol, especially at a time like this. But I think Mr. Sarogi made an important point that policy, of course, should be steady and consistent. And I think he used the word government should not be a trader trying to buy low and sell high, things like that. Well, I think 295 points lower, so it's a 300-point cut. 23,345 is where we're at. We'll take a break. We're back. Somil Mehta of Mirae Asset Sharekhan joins us with a view on markets. Stay tuned.
Welcome back. Markets selling off now, approaching 23,300. It's a 300-point cut on the Nifty. Sensex lower by 900 points. Perfect time to get in Somil Mehta, Mirae Asset Sharekhan. Somil, first just tell us why this 23,300 mark is an important support for our market. What happens if that gets breached? And then your stock calls.
Good morning. Good morning to everyone. the first thing, 23,500, 23,400 zone was the 61% retracement level of the entire rally which we saw since 2025 May, April. The bottom from where 21,800 was the bottom, and we went up till 26,300. Now that zone has already broken on the downside. 23,300 level, which you mentioned right now, there is a gap area which was formed last year, and that area becomes a very crucial support zone for the markets right now. If it breaches on the downside, again the next levels starts getting open. So now 23,000 is the next target, and if that level is broken on the downside, 22,700 becomes the next level. So these levels keep coming up as and when the previous swing lows or the gaps keeps filling on. So the trend remains negative in the short term, medium term, both, and I'll be expecting markets to keep selling off from here. My view is negative. On the upside, if there is a bounce, 24,000, 24,200 remains a very, very crucial resistance. Only and only above those levels, I'll be expecting a good bounce back, very sharp bounce back. So yes, view becomes negative in the medium term, short term, both. I have two stocks on the selling side. Persistent would be my first sell stock. A flag pattern has broken on the downside, already in the downtrend. Great setup for a short trade. Stop loss would be 4,700 and targets would be 4,400. UPL would be the next stock to sell. A triangular pattern has formed on. It's already in the downtrend. That triangular pattern has already broken on the downside. So stop loss would be 630. Target would be 580.
Okay, thank you very much for that. We will slip into a very short break with the news that the mid-cap index, which started off a little more resilient than the large caps, is now violently declining. 1,000 points lost on the mid-cap index. The fall for this week stands at 3.5%. Very small cap index will also come up for you on your screen. There also we're seeing a near 2% slide. On the other side is our special segment, It's the Economy. Lata will discuss the impact of surging crude prices, the falling rupee on India's macros. Samiran Chakraborty of Citi and Abhishek Upadhyay of ICICI Security Primary Dealership will join her.
Consumer price inflation was up by 3.2% in February. We heard that yesterday. And that is in YOY terms, year-on-year terms, driven largely by food inflation. But the CPI number is not becomes important only from March. If you remember, the first strikes in Iran began on February 28 and crude prices rose from March 2nd. So it's March CPI that becomes more important. Moreover, this time, the wholesale price index, WPI, which we have been ignoring so far, may become more important, given that the government may control what consumers pay for petrol and diesel and maybe even cooking gas. But industry has to pay much more for all crude derivatives, like, things which we hear less, propane, ethane, polymers. Also, all commodity prices like iron ore and aluminium are also rising because of logistical problems due to the war. So how will CPI and WPI pan out in FY27, and what will be the impact on other macros? I have with me two economists, Samiran Chakrabarti of City India and Abhishek Upadhyay of ICICI Securities PD. Gentlemen, good morning. Thank you very much for joining me. Samiran, first up, CPI, because that's what RBI will track. What is your math on how bad it gets in March itself? Because we know that gas prices and ATF prices are up, and I assume they go into a CPI. So impact in March and impact in FY27 more importantly.
So thanks, Lata, for having me. So I guess we have already kind of bottomed out on the CPI cycle, and we're seeing some gradual inching up of the headline CPI number. Now, from here on, if you see the precise impact of this LPG price hike, that's probably somewhere around, let's say, 10 to 15 basis points. But in general, because this upward move is going to continue, our sense is that we will get something around 3.6 for the next print. On CPI, there's still 15 days to go in the month, so we'll have to see whether there is any further revision in any of the petroleum product prices. The other thing that we are closely observing also is the relatively early onset of summer and the heat waves that are coming. So to what extent that distorts the vegetable price situation, the overall food price situation, that's also something that needs to be closely observed. But in general, we have just marginally upped the FY27 average CPI forecast from 3.9 to 4%. And we have talked about a 50 to 75 basis point of upside risk to that number if this conflict lasts longer. Right now, the petrol diesel weight in CPI is about 5%. So if we are moving into a phase where 5 to 10 rupee of price hike is required for retail petroleum products, then that can add 25 to 50 basis points to the overall CPI number. But we don't think that's coming immediately. For that, we need to have the crude oil prices sustaining at this high levels for a much longer period of time.
Fair point. So, I mean, I heard from economists that we were working before the war with probably $65 average for FY27. Now, it may not be outlandish to work with a $90 average. Abhishek, if that were the case, I mean, if we have such a substantial increase, even assuming that crude prices will ultimately come down, but the average may not be 65, but much higher, maybe 85. What is your sense about WPI, since there the government's actions won't work?
Lata, as you mentioned, WPI reflects the imported price pressures much more closely compared to CPI, where there's a big weightage for services, where food is a big component. So WPI, what we have seen is a broader rise in commodity prices, not just the energy complex that you mentioned. Crude prices are, of course, up, but petroleum products more broadly, jet fuel prices, etc., are up much more. That will have an impact. Plus, metal prices also, this year itself, metal prices are up 10% broadly. Since September, up more than 20%. all this will have implications for WPI. So in the current fiscal year, WPI should average very low, perhaps below 1%, closer to 0.5%. But for next year, while we were earlier thinking WPI averages around 4%, we're now thinking average closer to 5.5%, which of course impacts other metrics, including nominal growth, etc.
Yeah.
But we should not see the favorable spillovers that we typically see from good nominal growth on fiscal metrics, etc., because this is a supply shock induced increase in prices, and therefore the tailwinds from this will be limited also.
Oh, that's very important. Nominal GDP, yes, may likely go up. So we would look at maybe a 11-12% rise in nominal GDP, you think? I mean, I know for wrong reasons, but it is.
Yeah, so if we still think GDP growth could average close to 7% if prices settles over next fortnight to a month. On top of 7% real GDP growth, we are broadly working with a 4 to 4.5 average for CPI inflation. We were earlier thinking maybe CPI could average below 4%, but given recent developments, it is likely that even if prices and crude prices settle down, they will settle down at a higher level compared to what we were assuming earlier. But most of the pass-through will happen through weaker rupee. And with WPI averaging 5.5, maybe we could see a nominal growth in 11 to 12% range, therefore.
Yeah, government sources I spoke to are kind of happy about that. But as you say, that's not very positive, the reasons for which nominal GDP is rising. But Samiran, now to the downside. Do you think that, that the 7.6% growth of the current year is in danger? A whole host of ceramic companies, we were just speaking to PG Electroplast, they have not been getting LPG. So a lot of output has been hit, and consumption also may be hit. We've heard of gig workers and smaller restaurants. Impact of this quarter's GDP and FY26 GDP.
On a lighter note, Lata, we had 11 months of the year without the war, and only 1 month will be impacted by the war. So it's not that you will have a very significant change in the GDP growth number because of that 1 month issue.
One minute. If I may interrupt, Samiran, yes. March is a very important month. I mean, March accounts for almost 2 months. If you compare it to, say, June or April, the real hot months. So maybe it can have, it won't be 7.6, it may be less, you think, the overall GDP?
I mean, we have not revised our numbers down at all for FY26. But a quick point on that, on that nominal GDP thing is that this will be the real test of the double deflation method, because most of the price increases that we are seeing is actually for inputs. Yeah. So if that's the case, then in a double deflation method, you should see the real GDP coming off very substantially, and the gap between real and nominal widening much more. So whether that happens or not, we'll have to see. So it will be a good year to test the double deflation method.
But are you revising your FY27 number or at least giving it a downward bias? I mean GDP, Samiran?
Absolutely. I mean, there are multiple reasons why you could see growth headwinds coming and persisting, but it will all boil down to the duration and severity of this conflict, which honestly, at this point of time, it's a very difficult one to guess.
Mm-hmm. Okay, fair enough. Abhishek, have you tweaked your FY27 number at all? But the bigger question for you is, any change from Reserve Bank? I mean, they've been the most generous of banks, both with liquidity and with rate cuts. Do you think that they will have to start sounding hawkish sometime in calendar 26 or behaving hawkish?
Well, Lata, first on growth, as Samiran mentioned, we are not changing this year's growth estimate. In fact, we thought there was case for some upward revision to FY26 estimate because Jan-March growth has been implied to be comfortably below 7%. It is possible in the worst case scenario, we still get a 7.4% kind of number only when revised numbers come out. For next fiscal year, we are assuming, earlier we were thinking crude averages 65 to 70. Now we are assuming $80 on average. And therefore, while we earlier thought growth next year averages 7 to 7.5, perhaps closer to 7.5, it is now more likely at $80 crude, which is itself a big assumption. We get maybe closer to 7%, could be below 7% in the early part of the year. In fact, probably in the 6% handle in the early part of the year, when crude prices, energy prices generally are likely to be higher than the second half in our baseline. In terms of monetary policy, again, RBI starting point, they are in a good place. So inflation, H1, they were predicting 4% inflation, growth close to 7%, which is broadly potential in our view. So from here, I think what they need to assess is how much is the impact on inflation, how much is the impact on growth. It's still early days to make such calculations. But I don't think if you take into account, if you are assuming not a substantial increase in crude prices and maybe only $85 crude average next year, and then RBI should be able to retain current policy settings, which is current policy rate. At the same time, because inflation in the new series, particularly the underlying inflation metrics are so low, that gives them leeway to keep injecting more liquidity as and when that is basically withdrawn on account of their FX intervention operations. And that has been, and they have been intervening quite significantly. So in that light, the current approach where they have been quite preemptive and proactive, as Governor mentioned in the last press conference, likely that preference continues given low starting point for inflation.
Yeah, thanks. I'm rushing you because I just want to get one more word on the rupee from Samiran. 92.36 as we speak. What should we be prepared for next year? Should we be prepared for, say, 93, 95? As well, any special steps from Reserve Bank in terms of attracting capital flows?
I think, Lata, what RBI is trying to do right now is to ensure that whatever global uncertainty is happening, that does not get amplified through domestic financial markets, also exacerbating those uncertainties through large moves. So that's why the rupee move post this war has been actually very benign compared to movements in some of the other currencies. For FY27, I think the critical factor is that do we turn into a BOP surplus after 2 years of BOP deficit? And for that to happen, right now, we were very comfortable on the current account side, but depending upon where oil prices finally settle down, we'll have to see to what extent the current account stays that benign or not. I think that will be a new factor to watch out for. And then
2% current account deficit?
We are right now working with a 0.5% of GDP current account deficit for FY27. This is with the assumption that oil prices are averaging somewhere around 65, 70, and every $10 per barrel increase in oil price increases the current account by about 0.4% of GDP. So clearly, if oil prices stay at 80 plus, then it increases the current account deficit substantially to more than 1% of GDP. At that point of time, the BOP surplus story would be more difficult to sustain. But for now, we are still holding on to that BOP surplus view, assuming that the conflict is short-lived.
Okay. Well, that will require a lot of discussion, the external balance sheet of the country. Thank you very much for parsing the domestic implications of the likely increase we're going to see in inflation. That's it on this edition of Bazaar.